everyone, welcome to my YouTube channel where we discuss accounts, debit and credits. Like we said in our previous video, today we are going to be considering the ledger. I appreciate all those who have subscribed to this YouTube channel, and if you have not done so, kindly do that by clicking on the subscription button below. And also you can recommend this YouTube channel to others so that they can benefit from what we are doing here. So let's get started. So far we have discussed bookkeeping and accountant, where we say bookkeeper is different from accountant. Then we looked at in our previous video principles and practices of double entry, where we say you debit the receiver and credit the giver. Then we also look at the subsidiary books and source document. We will say source document, we have the receipt, invoices and so forth. I will also discuss subsidiary books. So we have a sales day book, purchase day book, return inward day book, return outward day book, the cash book and the journal proper. Then today we are going to be looking at the principal books of account, which is the ledger. So let's get started. What is the ledger? The ledger is defined as a book which contains in a classified and summarized form a permanent record of all transactions. The ledger is used for the double entry principle. The ledger itself is used for the double entry principle. The ledger is the final destination of all transactions in the subsidiary books of account. All the transactions that were recorded in the subsidiary books of account, they find their way to the ledger, which is their final destination. Now, it is the most important book of account. Why do I say so? Because this is where you employ the double entry principle. And I told you in our previous video that it is the double entry principle that ensures the balancing of the accounting equation. Then the ledger is used for the double entry bookkeeping, which I said earlier. So let's look at the division of the ledger. The first one that we have the general ledger. These are ledgers for real and nominal account. For example, expense account, we have an income account, then we have an asset account, even a purchase account. Then we have the personal ledgers. These are ledgers for creditors account and debtors accounts, for example, sales ledger and the purchase ledger. Then we have the private ledger. These are ledgers for capital account and drawings accounts. Okay, then we have the purchases or creditors ledger. This ledger warehouses the personal account of creditors or suppliers. Then we have the sales or debtors ledger. This ledger warehouses personal account of debtors or customers. Then we have the nominal ledger. This ledger contains account for losses, income, expenses, or gain. Okay, now let's look at the specimen of the ledger. How does the ledger look like? Look at the specimen of the ledger. And here we have the ledger account. Then we have the debit, the arrow which connotes debit. There's the arrow on the right hand side which connotes credit. You look at it, the ledger is divided into two parts with a thick line. Look at the thick line. This thick line is divided into two parts with a thick line. On both sides of the line we have the same information. Like we have the dates. On the left hand side, particular folio amount. On the right hand side, the same thing, date, particular folio and amount. Then the left hand side of is the debit side. The left hand side is the debit side, while the right hand side is the credit side, as you can see here. The right hand side is the credit side, while the left hand side is the debit side. So also say the debit side receives value and the credit side gives value. Like we said in the entry principle that you debit the receiver and credit the giver. So the debit side, which is the left-hand side, receives value. When the company is receiving value, it goes to the debit side of the affected account. But when it is giving out value, it goes to the credit side of the affected account. Then we have, it contains columns for date, particular, folio, and amount. Like I said earlier, on both sides, it contains date, particular, folio, and amount. Date, particular, folio on the credit side also. Then the folio is used for cross-referencing, while the date is for the day the transaction took place. Then particular, that description of the transaction. Then the amount, which is the value of the transaction. So now let's look at the accounts. What is an account? This is an account. This is a record in a double entry system that is kept for each class of assets, liabilities, revenue, and expenses. In a double entry system, a record kept in a double entry system for each class of assets, liabilities, revenue, and expense. So note please, when posting to the ledger, always use the name of the other account in the account you are posting. I will explain this with an example. On the 1st of February 2025, bought back from Delta PLC for 20,000 naira on credit. First of all, let's identify the two accounts this transaction is going to impact on. First of all, identify that this is not a cash transaction but a credited transaction. So the person we are buying from, this account or his name is going to appear in our books because you are buying on credit. But supposing you are buying in cash, the name of the person you are buying for is not necessarily going to appear on our book. So bought bags from Delta for PLC for 20,000 naira on credit. The two accounts that is going to impact on is the purchase account and Delta PLC account, because you are buying for Delta PLC on credit. We are going to pay them in future days. So but who is receiving value? Who is receiving value and who is giving the value? Number one, we are receiving value because we are the one buying the goods. The goods will come to our warehouse. So we are going to debit our purchase account with 20,000 naira. Then who is giving value? Delta PLC is one giving out the goods that are giving value. So it's going to go to the credit side, 20,000 naira, because they are giving out value. So now let's look at the narration. Narration, when you are posting to purchase account, you are going to reference Delta PLC. Then tell you that Delta PLC, we bought from Delta PLC 20,000 naira. I should go to Delta PLC account, I'll see this value that completes the double entry principle. So when I come to Delta PLC account, I check on the credit side because Delta PLC is giving out the goods. So on the 1st of February, I'm going to see purchase. Why am I seeing purchase here? Because that is the second leg of the account, telling me that if I go to purchase, I will see the other half of this transaction. Hope you understand that. Okay, now let's look at types of accounts. Types of accounts, we have the personal account. Personal account, these are accounts for the name of individuals, firm, and businesses, like Delta Park accounts, Moon PLC accounts, debtors and creditors accounts. That is a personal account. It's an account for the name of individual, firm, or businesses. So we have the impersonal account. The impersonal account, this account for properties, item of expenditures, and income. It can be further divided into two: the real account and the nominal account. To the real account and then the nominal account. Real account is an account for something that you can touch or move. Something you can touch or move, like we talk about the asset, property, plant, and equipment, as the IFRS calls it, International Financial Reporting Standard, like asset like equipment, motor vehicle, tables, furniture. Those are real accounts. So you have the nominal account. Nominal account is account for income, expenses, gain, and loss. That is nominal account. Account for income, expenses, gain, and loss. These accounts are temporary in nature. Why are they temporary in nature? Because they are closed at the end of the accounting period, referring to their balances to the profit and loss and transferring their balances to the profit and loss account or the retained earning. So they are not carried forward to the next accounting period. The life cycle of the nominal accounts is usually one financial year. Then let's look at types of nominal account. We have the revenue account. Revenue account, like we have the sales, the interest account, rent received. Those are revenue account. They have the expense account. We have the salary account. We have the rent expense. We have the utilities. Then we have then the gain and losses account, and the rule of the gain or sales of assets. Then foreign exchange losses. Okay, if you have any question to ask, please kindly drop your question on the comment section. In our next video, we are going to be continuing with this same topic, the ledger, where we'll be taking a practical question. I appreciate all those who have subscribed to this YouTube channel, and if you know you have not done so, kindly do that by clicking on the subscription button below. See you in our next video.